Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Hi everyone. Welcome to our video on palm oil businesses not invested in 2026. Today, we'll cover the risks, red flags, and why buyers and lenders are demanding proof, not promises. Let's get started. In January 2026, not invested has a simple meaning for palm oil businesses. They haven't put real money, people, and time into the basics that buyers now expect. That includes traceability beyond paper claims, smallholder support that actually reaches farms, replanting to raise yields without expansion, methane capture at mills, and verified deforestation-free supply. Some firms have a policy on a website. Fewer have funded work plans, data systems, and staff who can prove progress. That gap matters because the pressure is no longer only from NGOs. Buyers, banks, insurers, and governments are tightening rules and asking for proof on shorter timelines. This video helps you spot warning signs fast, understand business risks that show up in contracts and cash flow, and see what a realistic 2026 investment plan looks like for a mid-size palm oil company. What not invested looks like in real life, and why it is happening. Not invested often looks normal at first glance. A mill posts an NDPE statement, but the team can't tell you which dealers supply which days. A trader says it has traceability to mill, but can't share a complete mill list, let alone locations. A consumer brand buys certified volumes, while the rest of its supply is handled through vague mass balance claims with no timetable to improve. The easiest way to tell the difference is this. A policy is words, investment is work that leaves a trail. Investment creates purchase orders for mapping, training schedules for smallholders, contracts that require geolocation, and a grievance process with dates and outcomes. It also shows up in budget lines, named owners, and monthly reporting. A few practical examples. At the mill level, not invested means no effort to track fresh fruit bunch, FFB, origin, no screening for high-risk supply areas, and no plan for palm oil mill effluent, POM, methane. At the trader level, it means supplier engagement is reactive. Mills are added to a list but not checked, and grievances sit unresolved because no one owns the follow-up. At the brand level, it means sustainability teams ask for documents once a year, while procurement keeps buying from the same channels without stronger terms. This happens for plain reasons. Palm oil supply is messy, margins can be thin, and short-term targets can drown out long-term risk. But in 2026, staying still is like running a factory without a smoke alarm. You might be fine today until the day you're not. Common warning signs buyers and investors can spot fast. That's it for part 1. If you want to see practical solutions, investment plans, and steps to make your palm oil supply safer and more profitable, stay tuned for part 2. Don't forget to like, comment, and subscribe. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.